Let's bring in Michael Preiss, Chief Equity Strategist at Standard Chartered Bank, who joins us this Monday morning from Singapore. Michael, many thanks indeed for joining us today. I mean, we have got a lot of concerns. You've got the European contagion, Greece obviously, the US debt limit, that's more of a concern you could argue, and of course inflation here in Asia. How do you view the situation in the second half of the year?
I mean, neutral. I mean, this is our view because of all the headwinds that you just pointed out. We feel that the equity market is neutral, I mean, in our view, for global equities. And, I mean, just a couple of days ago, we flirted with the 200-day moving average. The U.S. equity market was about to go into negative territory. Then, the bailout of Greece, of course, leads to a lot of short covering and a major rally, actually, the last 5 days. But now, going forward, we expect it to be more sideways because we expect more headwinds. And this is why, again, our view on U.S. equities is neutral, and on Asian ex-Japan equities is also neutral. However, in China, we feel that China, you should be overweight on a 3-month and a 12-month view because the soft landing in China is successful, and we expect that the worst is priced in. So going forward, in a world where, for example, the Europeans increasingly have more austerity measures in place, even the U.S. with the debt ceiling issue, Japan also not really doing well. I think China is the market that, on average, is the most attractive because their liquidity is still abundant and they are succeeding in engineering a soft landing. So China, net, in our view, is the most promising market of the major markets in the world.
Michael, you did say back on June the 3rd when you last talked to us that the end of quantitative easing 2 was like crutches when leaving a hospital, but can the patient walk? So, the US, some would say, is a big concern right now. I mean, the impact on Asia, how severe would it be if they do or don't do quantitative easing 3?
I mean, look, quantitative easing 3 in our view is more unlikely. Maybe we see quantitative easing 2.5, anything but a name. But I suppose only when the equity market drops significantly, because I think also from a political point of view, it's more difficult for Mr. Bernanke to initiate quantitative easing 2.5, especially when the U.S. government is going into a potential government shutdown. But having said that, I mean, the issue about the crush is exactly that. I mean, we have the soft patch. The real question is how severe is the soft patch? I mean, our view is that next year we have positive growth of 3.6% again, but this coming period is going to be a little bit more challenging. This is why also the second quarter earnings season most probably going to be the more interesting one in a long time. Because the real question is, and you see the economists have downgraded their GDP forecast for the United States. A lot of stock analysts have still not downgraded their earnings estimates. And this is the real question. Do we see more earnings estimates downgrades rather, coming into the market, which have not been fully priced in yet?
So therefore, is the investor in Asia becoming risk averse, or are they looking from areas that they can actually take some risk on?
Now, I think you have to do your homework. I mean, increasingly, it is less of a liquidity-driven market. It's more of a stock pickers market. It's more about sector calls instead of just buying the broad market. And this is why I think our view still is that we should be overweight oil and energy, and to a lesser extent some of the more defensive sectors, because we feel that, yes, I mean, there are headwinds that are not fully discounted. The market action recently showed you it was actually going down significantly, and then we had this major almost bear market rally that is to some extent a little bit overdone as well in the very short run. So again, I think there's still a lot of uncertainties out there, and as I said, the real question is whether analyst earnings downgrades will come into the market.
We haven't had a Chinese rate rise as yet, Michael, but do you, I mean, you mentioned before that you believe that China for you is overweight, but again, the inflation monster does get worse, doesn't it? I mean, and also the debt issue in China. I mean, does that worry you at all as a strategist?
Yes, it does. But I mean, look what our European friends are doing. I mean, the Europeans learned this lesson from the Americans, just with the proverbial pushing down the can down the road. Yes, I mean, this China issue does worry me, but most probably not yet. It's a bit like in the United States. Everybody said they would be worried about the debt ceiling. Only coming to August the 2nd, people realized maybe now we have to worry about it. But in China's case, I think it's still very, very much down the road. So I think, as I said, in that scenario, China is a more attractive market globally, because there we still have time to push the can further down the road, which the Europeans learned from the Americans, but the Americans now in August come to a level where they have to deal with the situation.
Michael Preiss, thanks for joining us this Monday morning. Michael Preiss, the Chief Equity Strategist at Standard Chartered Bank, joining us from Singapore. That can is certainly being kicked down the road.